Let me describe a feeling I think a lot of you will actually recognize. The business is busy, work's coming in, the team is flat out, you are quoting, delivering, managing, keeping everything moving, and then you check the bank account and it's tighter than you think it should be. You look at the invoices you've sent, the revenue is there on paper. The work has been done, but the cash is not sitting in your account the way you expected it. And that feeling, that low-level financial pressure that never quite goes away, even when things are going well, is one of the most common things I hear from business owners. Jen, we're busy, we're doing the work, but it still feels like we're chasing money. If you've ever said something like that or felt it even if you have not said it out loud, this video is going to explain exactly what is happening and what to do about it. Because the reason is not what most people think. And once you understand it, you can actually fix it. Hi, I'm Jen Richardson and I'm the founder of 123 Financial Group. We work with small business owners across trades, construction and service industries. And cash flow pressure, well, it's one of the most common, consistent conversations I have. So today I want to explain why it happens, show you exactly what the cash flow cycle looks like in a real business, and give you a practical system for taking control of it. So before we get into the practical side, I need to explain something that trips up a lot of business owners, because without understanding this, the rest of it does not make any sense. Profit and cash flow are not the same thing. This sounds simple, but the implications are enormous. So profit is the difference between your revenue and your expenses over a period of time. It tells you whether the business is financially successful, whether the work you're doing is worth doing. Cash flow is something entirely different. So cash flow is the movement of money in and out of your business over time. It is about timing. When does money arrive and when does it leave? And here is the part that surprises most people. A business can be profitable and still run out of cash. How? Well, because profit is measured on paper, but cash operates in real time. You can complete a job, send an invoice, record the revenue, and show a profit on your books. But if a client does not pay for 60 days, that profit does not exist as cash in your account yet. It is sitting in a column on a report while your wages go out, your suppliers need paying, and your fuel card, well, that needs topping up. This is why some of the most profitable businesses I have ever seen still feel financially pressured. Their profit is real, their cash flow timing is the problem. The business, well, it's solvent on paper and stressed in practice, and the owner has no idea why. And it's because they are looking at the revenue coming in and assuming that it should be enough. Let me walk you through what actually happens to money as it moves through a typical trades or service business. I call this the cash flow cycle, and once you see it, you cannot unsee it. It starts before a dollar comes in. So stage one, money goes out before the work even starts. You win the job. Before you send a single invoice, money is already leaving the business. You're ordering materials, you're paying wages for the team doing the work, fuel is going on the card, equipment's being used, insurance is running, overheads are ticking over. The business is funding the job out of its own pocket before the client has even paid a cent. Stage two, the work gets done and the invoice goes out. The job is completed, the invoice is sent. On paper, the revenue now exists, but the cash does not. Stage three is the wait. Now the business waits. Standard payment terms might be 14 days, 30 days, or in some industries, even longer. During that entire period, the business has already spent money to deliver the job and is waiting to be reimbursed. Meanwhile, the next job, well, it's already started. More materials, more wages, more costs, all going out before the next payment comes in. And stage four, the payment arrives, but so does everything else. The money finally lands, but by the time it does, BAS is due, payroll's due, a supplier invoices come in, the bank balance briefly looks healthy, then drops again almost immediately, and the cycle repeats and repeats constantly. Now let me show you what this looks like with real numbers, because this is where it gets confronting. Say you run a business completing jobs worth around $30,000 each. To deliver each job, you are spending roughly $20,000 upfront on labour, materials, and other costs. The invoice goes out on completion and the payment terms are 30 days. If you have 3 jobs running simultaneously, you could have $60,000 worth of costs already out of the door before a single payment has arrived. The business is carrying $60,000 of financial exposure at any one time. That is not a sign of failure. That is just the cash flow cycle doing what it always does. But if nobody is managing that cycle deliberately, it will manage itself and it will not be gentle about it. So the cash flow cycle is a structural reality of running a business. You cannot eliminate it, but there are things most business owners are doing that makes it significantly worse than it needs to be. Late invoicing. This one is more common than you would think. The job finishes on a Friday afternoon. The invoice does not go out until Tuesday or Wednesday, sometimes even later. Every day the invoice is delayed, the payment clock has not even started. If your terms are 30 days from invoice date, a 3-day delay in sending the invoice is a 3-day delay in being paid. Across dozens of jobs over a year, that adds up to weeks of unnecessary cash flow pressure. No deposit structure. Most business owners complete significant work before collecting any money at all. If you're starting a $50,000 job with no deposit, you are funding an entire job until completion and payment. A deposit, even 20% or 30% upfront, means the client is helping to fund the job rather than the business carrying the entire costs. Progress payments for longer jobs serves the same purpose. Most clients expect this. The business owner is often the one who does not ask for it. And of course, no follow-up process for late payments. An invoice sent is not an invoice paid, but a lot of business owners treat it that way. The invoice goes out and then the business waits, passively, hoping. When payment does not arrive on time, there is no system for follow-up. It might get chased eventually, probably awkwardly, often too late. Late payments are one of the biggest cash flow killers in small businesses, and most of them persist simply because there is no consistent process for addressing them. And of course, no visibility over upcoming cash demands. So BAS is due every quarter, payroll runs every week or fortnight, supplier invoices arrive regularly, insurance renewals, equipment payments, loan repayments, they all land at predictable times. But most business owners are managing this from memory rather than from a forward-looking cash view. So when 3 things land in the same week, it feels like a crisis rather than something that could have been anticipated and planned around. So here is the practical system I walk business owners through when we start working together on cash flow. 6 steps that taken together change the experience of running a business completely. So step number 1 is invoice on the day the job is complete, not the next day, not at the end of the week, the day it is done. If you're using Xero, you can raise and send an invoice from your phone in under 2 minutes. There is no operational reason to delay it. Build the habit of invoicing on completion and your average payment time will shorten without you having to do anything else. Step number 2 is to introduce a deposit structure. For any job over a certain value, start requiring a deposit before work begins. What that threshold is depends on your industry and your typical job size. But a common starting point is 20 to 30% upfront, with a progress payment at a meaningful milestone and the balance on completion. This does 2 things. It reduces the amount of money the business needs to carry before payments arrive, and it filters out clients who are not serious, which saves you from cash flow problems caused by non-payment down the track. If you've never asked for deposits before and are worried about how clients will respond, most will not bat an eye. It is standard practice. You have just not been enforcing it. And step number 3 is to set up a systematic debtor follow-up process. So when an invoice becomes overdue, something should happen automatically. Not when you remember, not when the pressure builds enough that you pick up the phone, but automatically. Xero has automated invoice reminders built in. So set them up so a reminder goes out the day after the due date, another one a week later, and a more direct follow-up after 2 weeks. You set it once and it runs without you. For larger overdue invoices, a phone call will always beat an email. A 2-minute call is more effective than 3 reminder emails and far less awkward than you are imagining it will be. The goal is to make following up a process rather than a personal confrontation. When it is systematic, it is not emotional, it's just business. Step 4 is to build a 30-day cash flow forecast. So once a month, map out the next 30 days. On one side, the money you expect to come in, invoices outstanding, jobs due to complete, deposits expected. On the other side, the money you know is going out. So think about things like your wages, your BAS payments, supplier payments, loan repayments, anything scheduled. You do not need a complicated spreadsheet. Even a simple list in a notebook is infinitely better than managing it from memory. When you can see a cash pinch point coming 3 weeks out, you have 3 weeks to do something about it. Chase a slow payer, delay a discretionary purchase, draw on a credit facility. When it hits you on the day it happens, your options are far more limited. And step 5 is separate your operating cash from your tax and savings. We talked about this in the context of income tax in the last video, but it applies equally to cash flow management. So when everything sits in one account, the balance looks larger than it really is. You make spending decisions based on a number that includes money already spoken for. A simple structure: one account for operating expenses and wages, one account for tax and GST, and ideally one as a cash buffer for when the cycle creates a gap. Even a small buffer, 1 or 2 weeks of operating costs, removes most of the day-to-day financial pressure. And step number 6 is review your payment terms and enforce them consistently. What are your current payment terms? 14 days, 30 days. Do your clients actually know what they are? Are they on every single invoice you send out? And more importantly, are you enforcing them? Because terms that are not enforced are not really terms, they are suggestions. If your industry standard is 30 days, but your actual average payment time is 45 days, that's a 15-day gap in a cash flow problem hiding in plain sight. So tightening your terms and enforcing them consistently can free up significant cash without changing anything else about the business. So here is what I want you to take away from all of this. So cash flow pressure in a small business is almost never a sign that the business is failing. In most cases, it is a sign that the business with genuine potential has not yet put the right structure around how money moves through it. The business is doing the work, the revenue is real, the profit is there, but the timing is working against the owner rather than for them. So every step that I have just walked through is designed to shift that timing, to shorten the gap between money going out and money coming in, to make the inevitable pressure points visible before they arrive rather than after. When those things are in place, the business does not necessarily make more money, but it feels completely different to run. And of course that matters. So here are 2 questions worth sitting with for a moment. If you mapped out the journey of money through your business right now, from the moment you start a job to the moment that the cash actually arrives in your bank account, how long does that journey take? And secondly, of the 6 steps I just walked through, how many does your business have in place today? Because the gap between where you are and where you could be is not complicated, it is just structural. And structure is entirely within your control. And of course, if today's video has made you want to take stock of where your business actually stands financially, I've created a free tool called the Profit Engine Scorecard. 15 questions, 10 minutes covering 3 areas. How clearly you understand your numbers, how well your financial structure is set up, and whether your business is building genuine profit. The cash flow questions in this scorecard will show you quickly where your structure is strong and where it has gaps. The link is in the description. Download it and go through it this week. And of course, if you go through the scorecard and you want help putting the right cash flow structure in place for your business, that is exactly what we work on at 123 Financial Group. We work with small business owners in Newcastle and across Australia. The clarity call in the description is a straight conversation about where your business is sitting and whether we are the right fit to help. No pressure, there's no pitches, just an honest look at the numbers. And of course, the information in this video is general in nature and it does not take into account your personal or business circumstances. Please seek professional advice before making any financial decisions. Cash flow pressure is not something you just have to live with. It is a structural problem with structural solutions. And most of those solutions are simpler than you think. Give this video a like if it helped and subscribe, because next week we are talking about something that quietly kills profit in businesses that are doing everything else right, where the money is leaking out without anyone noticing, and how to find it. Remember, your business should support your life. So I'll see you in the next video.